Business owners always carry two hats. We carry the CEO hat, but very seldom do we understand that I carry the shareholder hat as well. And you've got to separate the two. And you say to yourself, at the start of the business planning process, as a shareholder, what instruction am I giving to the executives of this firm to deliver in terms of profit for me by the end of the next financial year? That's an ROI equation.
A business's purpose in some regard is to serve the needs of the owner, right? In a certain capacity, but also to serve the needs of the market. If a business owner is delivering all this value to the marketplace, but not receiving anything for it, and therefore the owner of the business is broke, they have a terrible family life because they have no freedom from their business, this results in a burnt out business owner. And then a burnt out business owner ultimately will always implode. Welcome to another episode of the Bill Hauser podcast. Today, I'm sitting down with Pieter Schultz, who is one of the brightest business minds I've ever encountered. And I am excited to unpack some of the business principles that's allowed him to advise over 1,000 businesses and over 150 businesses that he's worked with directly over the last few decades. So much business wisdom to unpack in today's episode. What we're really going to be talking about are the fundamentals of a successful business. And I can't think of anyone better to talk about this with than Pieter. And last week, we had the privilege of sitting down with virtually Vic Cufatelli, who has an equal amount of business wisdom. So really excited to unpack some great business principles in this week's podcast. So Pieter, why don't you introduce yourself, and then I'm just going to ask you questions about all this wisdom you've accumulated.
Yeah, thank you very much, Bill. Basically been working with SMB now for just under 2 years. Prior to that, I ran my own business and executive coaching firm for about 18 years. And just in the background prior to that as well, spent 25 years in corporate world across multiple industries, both from a mining industry to motor manufacturing to the last 16 or 17 years of that was in the fast-moving consumer goods industry, where I was fortunate enough to be appointed to the board of directors of a major multinational in South Africa. But in 2006, I made the decision to get out of corporate for myself and to start building something for myself, etc. And that's where the coaching career really kicked off from. So that's in a nutshell, so a bit of my background.
Yeah. So let's just start with Business 101. And I know that you're quite a philosopher when it comes to many of the principles that allow a business to succeed. But when I say, what is a business, where does your mind go?
Yeah, I think very good question. The what is a business is answered for me as follows. It's the services that I provide to clients for fair value exchange. And so the products and services that we provide as business owners to our clients must be a product or service that for which there is a need. And we know when we create the need, there is always a problem that needs to be resolved. So the products that I provide or develop must address a problem in the market. And how I then provide the product or the service to address a particular problem is part number one. The second component of that then becomes, well, when I provide that service is for what I refer to as a fair value exchange. The client must receive the value for the product that he's bought or acquired, and I must receive my commensurate value. And so there has to be that fair value exchange that takes place. But in such a way, if you add on to that, so first and foremost, a product and service that the client needs or that meets a particular problem in the market, that ultimately provides a fair value exchange, but in such a way that there is the client is left with a perception and the belief that he's received more than what he's paid for. So if you get that right, in simple terms, then you've got an ongoing business going forward.
So when you simplify the definition like that, do you say of the 100 1,000 businesses you've worked with and your team's worked with, would you say most people are not capturing enough value in exchange for the value that they're providing? Or would you say the reverse is more common, where they're making a lot of money, but they're not really delivering the value to people?
I think oftentimes it's the first component of that, where the value that the client is getting is higher than what they initially receiving. And therein comes in an important component, an important matter to be addressed, and is the mindset that I, as a business owner, and so I come back to the definition of value, and value then for me becomes the products and services that I offer for, the ongoing development of that particular product to the business, and making sure that I'm getting the value for that. So the mindset issue for me always comes back to one that says, do I truly believe that the product or the service I'm offering the client is of value for them?
Yep.
And I think that that's probably one of the biggest issues that business owners struggle with, is that they undervalue their own proposition, but they over-deliver. And that has multiple ramifications for the business going forward.
Yep. Like low gross profit.
Low gross profit.
We talked about
low
earlier
cash
today,
flow.
Right? And, also, as something you've said many, many times, and Vic has said, a business's purpose in some regard is to serve the needs of the owner, right, in a certain capacity, but also to serve the needs of the market, which I'd add in from what you just said. So if a business owner is delivering all this value to the marketplace, but not receiving anything for it, and therefore the owner of the business is broke, they have a terrible family life because they have no freedom from their business, because they don't have the excess cash flow to afford to hire more people, or to pay their people enough money so they can actually attract A players to their team. This results in a burnt out business owner. Yeah, exactly. And then a burnt out business owner ultimately will always implode, right? This is why 80% of businesses don't last past the first 5 years, is you have a business owner not getting their needs, or you also have the market not getting their needs. But it's happened just as frequently for the market getting a great service and the business owner just burning themselves out because they're not getting enough from the service that they're providing to people. So when you look at a business owner who's delivering the value to customers and clients, but not receiving the value back in terms of excess cash flow, profitable income, how do they go about solving that?
Well, I think the first question I always ask people is, how sustainable is that model? Because they can come up with a variety of reasons why that is the case right now. And the question that we've always got to ask them is, so how sustainable is that which you are delivering or experiencing in the business right now? It might suit your short-term requirement now, but is it sustainable? And then you start unpacking, what does that look like? What does the future of this business look like 6 months, 12 months from now? And what needs to change? And so one of the comments I've often made to business owners, they don't want to take a price increase if the pricing is the issue. They don't want to in actual fact address accounts receivable, and because they're in a state of comfort. And one of the comments I always make to business owners is, choose your pain. Choose the pain of taking a pricing increase if pricing is an issue right now, or choose the pain of making sure you're addressing your accounts receivable, or choose the pain of sitting without cash flow at the end of the day. But at the end of the day, if you don't address that in the business right now, how sustainable is that? Where are you going to be in 6 months' time from now? And is that what the business owner wants? And it's getting them to realize, first and foremost, that when you paint the picture of what this is going to look like for them in 6 months or 12 months from now, that sometimes the light switches on for them then, and then you can work with them.
And what do you think, once you start training a business owner to have that longer term perspective, which I think that's in some capacity, that's why having an advisor, having a coach, having a mentor is so critical, because oftentimes as a business owner, you're just in the grind. You see 5 feet in front of you and that's it, right? You can't see 10, 20, 30 years in front of you at all. You're not even thinking about that, right? But when you ask and pose the question, is this sustainable? All of a sudden they're forced to start thinking 6 and 12 months out to actually calculate, am I gonna run out of money if I keep doing this, right? So let's say the business owner starts seeing that longer term perspective. They realize it's not sustainable. What are the key pieces of data I have to look at in my business to fix that problem? When you're looking to inspect a business that is not run optimally, when you ask that sustainability question, is the first thing you're going to look at cost of acquisition? Is the first thing you're going to look at gross profit? Is the first thing you're going to look at some other revenue generating metric like lead generation or intake, sales, conversion rate? Where do you start from a data perspective?
There are many ways, in my opinion, to address that. But the first thing that I've learned over the last couple of years to address that, just to get that first view, and that is what I refer to as the 7 levers of cash flow.
Okay.
And that is pricing, that is volume, which becomes a lead generation debate.
Okay.
It becomes cost of goods sold, and you spoke about that earlier on today, is get an understanding what the gross profit margin looks like. Yep. And ultimately, so then go and look at what your overhead component in the business is and break that down into its particular categories to get insight into what's happening.
Okay.
The next group of KPIs or information I want to look at is, as we mentioned earlier on, which are directly attributable to cash flow, is accounts receivable. The second one is what I refer to as work in progress. In different businesses we look at inventory. But even in a legal firm, you look at work in progress. How many cases does the client have sitting in process at the moment that they haven't given attention to bring it to close, which means when they bring it to close, we can invoice and get cash in the business. And then last one, which is, thank God, not a big problem for many clients, but the accounts payable portion thereof, but you cannot ignore that. So just to repeat, I look at those 7 key components of cash flow. 4 of them drive profitability, and 3 of them drive cash flow directly, but they all impact on cash flow, because very quickly that can give me a view on where the business is and where do I need to go and dig further in the business.
And I love the first thing you look at are the levers of profitability and cash flow. You don't just look at cash flow and you don't just look at profit. You're looking at a merge of both.
And when you understand those drivers at a higher level, that gives you insight into where to go and dig further. So if your overhead component is sitting at double what it should be, for instance, and we often refer to, compensation as a percentage of revenue, and it's sitting at 60%, not at 40%, guess where the attention is going to go to. But in my opinion, if you want to get a good handle on what's going on in a business, is first step is to get an understanding of what's happening with those 7 levers, because that then it gives you an attention to say, where do I need to go and dig further, and provides you with a priority of where to go to going forward, because there's always going to be a ton of stuff to work with.
Yeah, I think for me, one of the most challenging habits I had to learn as CEO is to be a little bit slower in decision making until I have at least 80% of the data clear. Because some of the most, I wouldn't call them reckless, but some of the decisions I made that were non-optimal, that caused us to have to pivot and change and constantly kind of backtrack from the original decision, came from incomplete data, right? And I think if there is one mega skill that I think is so unlocking, I know it was unlocking for me, but for business owners, is using financial statements to make decisions, right? Because if words must exist for us to speak language, then financial statements must exist for us to speak business, right? Because the financial statements are the words of the business, right? It's the tune, it's the song of the business, right? So you can't analyze the business without the financial statements. And for me, theoretical measurements, I think, can cause you a ton of problems. Like this, let's say that we just look at the gross profit of a certain service, right? And that's great. And show me in the financial statement in both your cash flow and your profit and loss statement. Show me where the income and the expenses are from a profit standpoint for this and from a cash flow standpoint. If you just look at it from a profit standpoint, P&L, you may think, oh, wow, this is perfectly profitable. And then you may look at your cash flow and you may see, oh, well, we thought this was making us a lot of money, but we haven't received 80% of the income we were owed, right? And that's an accounts receivable problem. So when you look at things from one layer of profit or cash flow, sometimes you don't get the whole story. And then the other thing is, how do you tie your KPIs to the financial statement? KPIs meaning key performance indicators. How do you take your, let's say, your marketing metrics, right? So let's say that your cost per lead is $100. You pay $100 in marketing spend to get one qualified lead, right? Great. Let's validate that in the financial statement. Let's see, of the X thousands of dollars we spent as a whole on marketing this month, does that check out? Did we actually get 10,000 leads for the $100,000 we spent on marketing this month? That should be $100 a lead. But if we think we're getting $100 a lead because we got a marketing report from some internal person on our team who has never seen our financial statement, and they say, oh, your cost per lead is $100, right? Well, me as a business owner, I think to myself, let's zoom out a little bit. Let's see how many leads we got in the entire last 30 days, and let's compare that to how much we spent on marketing in the last 30 days, and let's validate that our cost per lead is actually $100 from the financial statement too, right? Because oftentimes, when you have members of a team who never have seen your financial statement, they will give you information from their vantage point, but not from the business's vantage point. And I think that's the role of any executive leader or CEO, is you really have to be the fact checker of those numbers. Because we had a meeting last week actually with our marketing team, and at the beginning of the meeting, it was said that we should turn off one of our marketing campaigns. And here's why: because it's costing us too much, right? So Andy and I started asking questions. Wait a second, did we track this? Is it tracking all the lead sources? And after a couple follow-up questions, we found out it was actually our most profitable campaign in our entire company, and there was just 2 little pieces of data missing that then quadrupled our ROI from it. And just because someone didn't think of it from a holistic perspective, we may have turned off the #1 performing campaign in our company because we had incomplete information. So how do you think through using data to make decisions? And why is this so challenging for entrepreneurs to slow down, get the data right, and then go full force once they have the right data?
Yeah, I mean, I like the fact that you talk about, linking the data, say lead volume data or lead cost per lead data to your financials.
Yeah.
The other thing that I often talk to business owners about is doing what I call vertical and horizontal comparisons. So if you look at an income statement, a P&L, profit and loss, and you do the vertical comparison, compensation as a percentage of revenue, fixed costs as a percentage of revenue, marketing as a percentage of revenue, et cetera, operating profit margin as a percentage of revenue within one financial statement. The next question is, when you go and look at that measure for, let's call it July this year, let's go back and look and see where we were this time last year, which is the vertical analysis.
Okay.
So if you see that your compensation as a percentage of revenue is sitting at 45%, where was it last year? It might have been 35.
Yep.
But have we seen, now we've invested, because I've had a lot of business owners say, Pete, but I'm investing in people ahead of the growth. So the question is, did the growth come through?
Yeah.
Did the growth come through? And I've had many examples where clients said, no, but we're investing ahead of the growth.
Yep.
Said, that's what you've been telling me for 3 years.
Yeah.
And then 2 weeks later, they end up retrenching. So the question is, do your vertical analysis, those comparisons within the income statement, but then go and take those same comparisons and say, let's compare this to this time last year. So you can look at the shifts in data and start asking yourself the question, does that shift in data support the narrative that's been going on in the business? And I use compensation as an example. Same thing in marketing. If your marketing expenditure has been sitting at 20% this year, for example, where was it last year? Does that show in the in the revenue numbers?
Mm-hmm.
And if not, what's going on? It gives me an opportunity to go and dig deeper again to find out what's driving this, or what decisions did we make that is driving this particular issue. Does that make sense?
Yeah, I think knowing what the contributors are to growth or lack of growth allow you to become more disciplined in your decision making and to stop making sloppy statements like, oh, we're investing in growth, right? And fact checking that, because I think in my own reflections in business, especially around profit, which was not a strength of mine in my first 6 years in business, top line revenue was growing the top line was my strength. And over time, I realized that you can get both. You can grow the top line and grow the bottom line. And I realized I was tolerating sloppiness. And my sloppiness was being tolerated because I would tell myself, like you said, we're hiring in advance of our growth. We're staying ahead of the trend here. We're hiring a little earlier than we should. We're spending X on marketing because we're spending for growth, right? And what was actually happening beneath the scenes was I was giving the entire company a permission slip to be sloppy and to just spend and never really analyze our spend. Because everyone's, Bill says we're spending for growth, so everyone can spend happy, slappy, whatever they want, right? That's what the team heard, but that's also what my emotional state was. That was actually where I was coming from until we ran out of money. And that was like 2 years ago, right? And it was the best experience that ever happened to me. Andy and I had to wire money to our company's bank account, and yet we're growing rapidly. This is the year that we went from something like 14 million to 20 million or something or whatever. Actually, I think it was the year we went from 18 to 14 million, or 8 to 14 million.
8 to 14.
And so that was almost 100% year-over-year growth, right? So on the surface, oh my God, woohoo, we're growing, and yet we ran out of money. And part of that was because QuickBooks held some of our client payments for some reason, some big glitch. But then once we got the payments released from QuickBooks, we realized we had a problem. And it was so fresh in our minds that it was that day we actually hired a consultant and we created our first robust, what we call a driver model, which is basically a very detailed version of an annual financial strategic plan, right? And that revolutionized our business when we started looking at the inputs that produce the financial outputs and predicting them. Because every year prior to that, it was a guess. It was not a prediction. It was not a forecast. I didn't even know the difference between goal setting and forecasting, right? Because for me, it was all just set a pie in the sky goal, cross our fingers, and hope we get close, right? And that was the first year we did our first legitimate forecast. We said, okay, let's assume everything goes wrong. Let's do very conservative growth measures. Let's create a worst case financial forecast. And as soon as I saw that worst case financial forecast, I got pissed off. And I was like, okay, things have got to change. But the problem is when I was setting these big stretch goals, since they're all in fantasy island, right? I never actually saw the need to change because I just kept deluding myself. And really, I think it's important to be a little delusional as an entrepreneur because you got to get started with some big vision, right? But then if that delusionality kind of makes you pay the price down the road, you got to get it in balance at some point. And I think forecasting is one of the most important skills to learn. The ability to predict to the dollar how much net profit will be in your bank account at the end of the month, both from a profit and from a cash flow standpoint, to be able to predict that. And then also on top of that, to be able to predict exactly when to hire someone based on hitting a capacity metric or a certain revenue or profit metric. To have that freedom, I don't think there is any level of peace better than that a business owner could cultivate, is to know to the penny in advance, call it 6, 12 months in advance, to know to the penny, especially even if I don't show up at work for that next year, the company's going to do this much in revenue.
Yeah.
Have you seen business owners have that experience of liberation when they finally start feeling there's some predictability to this business?
Yeah, I have. I mean, I think a couple of thoughts come to my mind as you run through that. One is, and we spoke about that early on, is the concept of fear. And the opposite of fear is the gaining of more knowledge. The more knowledge you have of a particular situation, the more comfortable you feel and confident you feel about what you're doing. So if you look at fear of financials or fear of failure in the business, what's the opposite of that? The more knowledge, the more insight into what's driving the business means my level of confidence grows. So that's one component. The second point that I want to make to that was we go back to the concept that the business is a vehicle for me to achieve my personal goals. And oftentimes when we set a business goal at revenue level, we haven't truly reflected about what is it that I want out of the business. And so the starting point for me becomes for business owners is to say, what is it that you want out of life? Coming back to that definition, what I always refer to as the definition of financial wealth as an individual, is the passive income that I earn from assets that I've bought outside of the firm that equal or exceed the compensation I'm paying myself from the firm at the moment. And therefore then saying, once I do that and I get the profitability out of the business, what is it that it's allowing me to do in my personal capacity? Be it in terms of building property portfolios, investing in other businesses, contributing to society, whatever the case may be. Because that's where people get excited. Nobody wakes up in the morning getting excited about my business doing $10 million profit this year. That's not excitement. That's just a number. They get excited about what the opportunity that the business provides them allows them to do at a personal level.
Right.
And then the third thing comes back to me when we bring this thing back at business level was. And I remember sitting back when I was at board level in South Africa. We used to get an email from the shareholder at the start of the planning process in about July the preceding year. We need X profit in 2026. Okay. And then it is up to the executives to go and run the numbers, run the scenario planning, run the strategic planning, and run the financials to deliver that value, whether it's $100 million profit or whatever the number was. And that's what we get paid for. And so if we understand that particular process, what we don't do in business for ourselves is that we recognize that business owners always carry two hats. That we carry the CEO hat, but very seldom do we understand that I carry the shareholder hat as well. And you've got to separate the two. And you say to yourself, at the start of the business planning process, as a shareholder, what instruction am I giving to the executives of this firm to deliver in terms of profit for me by the end of the next financial year? That's an instruction. That's an ROI equation. I put X amount into this business, I need X amount return out of this business. And that number's fixed. Then it's my role, put on the CEO hat or the executive hat and say, that instruction's been given. Now, what do I need to do both at a financial level and a strategy level to be able to deliver to that number? Now, I can get to that $100 million profit level, but by only growing revenue by 20%. Because I'm more efficient in the allocation of resources and time and everything in between that. So to me, the goal isn't the revenue number. The revenue number is just an input. The goal is a profit number. And then when we work through that particular process about, as a business owner, I've got two hats, the shareholder hat and the executive hat. And then the question I often ask clients is the following. If at the end of the financial year, you had a board meeting and you put on your shareholder hat and you ask yourself the question, given the results that I've delivered, that the executives have delivered to this firm, would I re-employ myself as CEO of the firm, yes or no? Or alternatively, if you were to bring in an external shareholder, chairman of the board, and he or she had the opportunity to determine whether they're going to re-employ me as their CEO of the firm, would they re-employ me? So it gives me a very different accountability factor. to what I need to do to the business.
Yeah.
Because one of the biggest challenges in running our own business is we're not accountable to anybody other than the bank manager when we run out of cash.
Yep.
And so if you start understanding that component between shareholder and CEO or executive, and recognize that I have an accountability to the shareholder, that sometimes it's the same individual.
Yep.
But I've put in X amount of dollars into this business. I have to deliver that. That's a non-negotiable number. How I run the business, the financials, the allocation of resources, which is something you taught me at the beginning of last year, that strategy is the decision around allocation of scarce resources. Never thought of that before. And I love the simplicity of that discussion. Because that's ultimately what we do as executives in the firm. We make decisions day in, day out, week in, week out, about how do I allocate resources to achieve that profit number. Does it, does that answer the question?
Yeah, I think, and the wisdom I wish I had earlier was to set targets around the profit number. There's so much wisdom to that. And I think, profit is business wisdom. Top line revenue growth is business chest pounding, right? So you pound your chest, you feel all confident, you high five some people about it, if you're competitive. But most people aren't going to be high fiving if they run out of money at the end of that roller coaster, right? And what's a big awakening for me, and I love what you just said, segmenting the shareholder from the actual CEO. For me, my goal when I was unemployed and I started this company, my goal was to do $256 million in revenue. That was the goal, top line revenue. I didn't care if I did $0 in profit at that time. Now you got to understand, I was 25 years old at the time or so. So I had no business experience at all. So I didn't know how important profit was. I read a book about setting big goals. So I set a big goal and then I went off to the races, right? For the first 6 years, I set all these goals. I got close to all my top line revenue goals until the time I told you I ran out of money. And when that happened, running out of money, not only did we put in those financial policies and forecasting methods, but my internal compass towards setting goals also changed. To your point, from top line revenue growth to enterprise value, right? And the reason why I'm so fascinated with enterprise value, which I know is what Value Builder helps with and other tools we've introduced our clients to, is to me, enterprise value is the ultimate reflection of a business's health, right? If your business, there's two components that create enterprise value, EBITDA and the multiple, right? And then the other criteria we could say outside of that is willingness to buy. Someone's actually got to be willing to buy your business, right? Otherwise, what's it worth? Unless you just keep running it yourself and autopilot it, which is perfectly fine. But to me, enterprise value is the holy grail business metric. If you want to talk about KPIs, the shareholder KPI is in essence enterprise value. Because let's say you do get to 10 million in profit, but you only get a 1x multiple because the business is completely owner dependent. It doesn't run itself at all. You have client saturation, meaning you have one big client that's paying you that 10 million. And if that one client leaves, you're screwed, right? All things we measure our clients on. I think to myself, and I think, well, that's not really that healthy of a business. If it's completely dependent on me, completely dependent on one client, it's good. It'll be good for a little bit of time, right? But to me, that's not as sustainable when you ask the sustainability question. So maybe I'd rather set the milestone of having a business that does 5 million a year in profit that involves none of my time and has zero client saturation, because that's a little bit more sustainable. And then I can build up to 10 million maybe in another year or two, instead of just, I must do 10 million in profit now, right? Because you can make bad decisions if you only make it for short-term profit. I think that's why a lot of people have formed animosity towards big corporate bureaucracies is because they put profit first at the expense of their customers, at the expense of their employees, right? But I think the great business owners, they put profit first in a sustainable way so that they can reward their employees more, so that they can reward their clients more, right? But that profit first mindset was something I was not blessed with in the beginning. And I think there's so much wisdom by setting profit goals, but then also understanding the importance of your business's multiple. And I also think your business's multiple is a reflection of the health of the business, because if your business is not dependent on the owner, if your business has recurring revenue, if your business is not dependent on one customer, not only are you going to have a more valuable business, but me as the owner, I'm going to have a happier life if I'm not dependent on one client, if I'm not dependent on me doing everything, right? So I think there's so much wisdom. Maybe this would be another book I'll write in the future on why enterprise value is the number one metric in business, because it is a reflection of profit and because it is a reflection of the business's scalability and sustainability.
Yeah. Yeah, interesting, because, and I agree with you 100%. I remember years ago, if I can go back probably 20 something years ago, sitting on a plane with a colleague of mine, we were talking about basically what you were talking about. We called it the salability model.
Yep.
And we said, as we build this business, what do we do to this particular business to get potential value out of this thing 10 or 15 years down the road?
Yep.
And I came up with a model that really just spoke about 4 or 5 components to that, based on some of my previous experience. In corporate, when I was fortunate enough to be involved in a couple of mergers and acquisitions, the number one thing that an acquisitor will look for is cash flow. Because if they're investing money, they want to know, is this business generating sufficient free cash to pay me back for my return on investment?
Yep.
So the first thing we look at in terms of this salability model I used to refer to is, what is this particular business's ability to generate free cash right now, number one. Then we'll start looking at profitability, because profitability you can manage, you can manipulate.
Yeah.
But free cash, I'm putting in $100 million to buy this business. Is this business generating cash already that is giving me a safety mechanism I'm going to get my return on investment? The second component of that salability model is, what assets am I buying? What assets am I buying in physical assets, IP assets, whatever the case may be, because there's a value attached to that.
Okay.
The third component of that sort of model that we spoke about at the time is what I really just called about PPS, people, process, and systems.
Okay.
Because people, process, and systems deals with the concept of whether I, as a business owner, can extract myself from the business or not, or whether I'm key to the business.
Got it.
Okay. So what systems, what processes do we build? Number one, to have sustainable systemic growth in the business, but also to free me up, coming back. And then the last one is, to your point earlier on, is around, when I invest $100 million in this business, how comfortable now am I that I'm going to be able to continue to scale the business? Nobody is going to pay you great enterprise value for the business, or pay you what they want, what you want for the business, if they don't see the future growth opportunity.
Right. Yeah.
And so if you go and look at that hockey stick curve, when's the best time to sell the business? At the top of the hockey stick, or just below that? Because
the top,
unless you are developing a very clear story of future growth. I remember when we sat at corporate level, a lot of the discussion we did when we were selling businesses is not only preparing the financials and everything else for due diligence, but part of that whole story was developing the story for future growth for the acquisitor.
Okay.
Because if they didn't buy into the fact $100 million, but I can, based on what the current business owners are telling me, to be confirmed, I can turn that to $200 million, they won't give you the value for it.
And
then lastly is the culture.
This is what someone taught me, and so I would edit what I said then based on what you said, that cash flow would be first, right? It wouldn't be just net profit. It would be free, unencumbered cash flow.
But they linked. But you're right, cash flow first.
So I want to piggyback on this. Someone who is mentoring me right now, who runs a $500 million enterprise value company, he always tells me the enterprise value thing that you're talking about. Who are they gonna sell to? Right?
Yep.
So let's say big company comes in, they want to write a big check for your company, right? Well, that company, whether it's private equity or whatever, venture capital, they come in. If they sign a check for your business, that person signing the check, they should already know in the back of their mind who they're going to resell that asset to 5-10 years from now. Because it's very rare that somebody is going to buy your business if there's nobody who would buy it in the future. It's rare. I mean, there are people who buy businesses for long-term investment, but more times it's kind of like a fix and flip, right? Like in real estate. They're trying to make some quick optimizations to your business, increase EBITDA, have a little bit of growth, 20% growth, and then 5 years from then, flip it to someone who will pay an even higher multiple on that increased EBITDA number, right? And to me, people never really think of that. I mean, our company got, in our last valuation, a 10.4x multiple, right, on earnings. So clearly, we made the case that there is a market for expanding this business, and that's simple for us because it's just vertical expansion, right? It's we did this in one vertical, right? So we could bring it to 100 different verticals, and there's clear expansion. But that storytelling is important for a local business because local businesses that are constrained by geography, there's an inherent limitation in that, right? If I'm the biggest seamstress in northern Nebraska, right, and I want to sell my sewing company, right, in northern Nebraska, in a population of 50,000 people in my area, there's not much growth there. So I have to present that business with an international or national expansion strategy for it to be worth anything, right? So I think that's a really good point. Starting with cash flow being a huge insight for me that I didn't even think about. And when you're talking about cash flow, if you had to pick one, what would you say is more important? Would you say cash flow is more important than profit, or would you say profit's more important than cash flow?
I would say cash flow.
Okay, why?
I would say cash flow because cash flow funds the growth.
Okay.
As I said early on, you can manipulate the profits, the P&L of a business if you wanted to.
So give me for
but
people.
Cash flow funds growth.
For
With
people
cash flow, you
who
can invest
aren't,
back in.
So if somebody's not as experienced in interpreting financial statements, how would you break it down for 101? What is the difference between cash flow and profit?
Well, cash flow for me, if we break it down into simplest terms, if you speak to the financial people, etc., they can develop longer term cash flow models which become complex. But simply put, cash flow is in a given period of time, month by month, what are the expenses that I have to pay at the end of this month or during the course of the month, vis-a-vis the revenue I'm bringing in for the month.
Okay.
Starting with the opening account balance, ending up with the closing account balance after that, including any particular loans that I've granted into the business going forward. What's the availability of the cash flow in the business? Is it positive or negative? That says to me that I can meet my expectations.
Okay.
All right. Profitability for me, and to a degree that if you're running a business on a cash accounting basis, they're very closely linked.
Yeah.
Very closely linked. The only difference primarily being that any loans to the business or credit or loans that you're providing the business are not included in your P&L per se. But if you're running on an accrual system, it's very different.
Yeah.
On the very different. And so when
once you get the 20 million in revenue, I believe you have to transition to accrual for most industries, right? Because we've had the transition to accrual from cash.
Yeah. So that to me is because that gives me the comfort.
Yeah.
That I know that if these are my expenses for the year, for the month, we can meet them, no problem. Which lends me back, just to come back from that, when you start asking business owners, what is the number one thing that keeps you awake at night? and you can go to many iterations of that, 99% of the time it's any particular cash flow issues. So how do I get back to your earlier point about burnout? How do I get back and say, how do we address that level of comfort, that level of peace that people should be having, freedom that people should be having running their business? If you've got a business pumping cash, you've got 99% of your problems resolved. Okay. Because then the question is, if you've got positive cash flow, then you can start saying to ourselves, how quickly can we scale up and build this business going forward? Where do we invest in people? Where do we invest additional money in marketing? Because the number one question we get from working with clients in SMB at the moment, I can't afford to invest more money in marketing. Why? Because I haven't got more cash. I'd love to spend more money. So my role then is, in actual fact, to make sure that the business is generating the additional cash flow, and then it's an decision around allocation of resources. I'm going to invest more money in marketing first, or do I need capacity first? And that's a trade-off decision that you need to make. So to me, the cash flow is a fundamental issue, and it comes back to that old saying, you've heard it before: sales is vanity, profit is sanity. Cash flow will always remain king.
Who came up with that?
Oh, I can't remember now, Bill. You asked me.
I think there's a book. I read it a long time ago. It's recommended by Vern Harnish in Scaling Up.
Yes.
Crabtree is the author. Simple Numbers, Straight Talk, I think it's
Something
called.
like it,
yeah. And I think cash flow is something I'm going to put more emphasis on for our clients and customers, because for me, we don't really have cash flow problems because we have recurring revenue, right? And our billing is so predictable as a company. There's no ebbs and flows. But you look at some other businesses, it can be extremely volatile for some businesses. And I think the goal of a CEO is to create that predictability, is to innovate a business model that either has a form of recurring revenue or that level of predictability that you're talking about from a cash flow perspective. Because I can't think of a better stress management pill that you could take than having predictable cash flow.
Exactly. If you go back and you look at the valuations on, and I'm not a financial person, but if you go and look at the valuations on software companies, and you look at the multiple valuations in those companies, they're huge. Why? Because they've got clients locked into a monthly recurring fee or an annual recurring fee. That whether you own the business or whether I ultimately own the business, those clients are locked in, provided, of course, I continue to provide them with a service for a fair value exchange. But then locked into multiple term agreements. And therefore, with that comes multiple valuations. The moment you go into a business where cash flow is fluctuating or very thin, etc., the first question a business owner or an investor is going to be asking is, why would I invest money in this? So when I was still in corporate, we used to look at not necessarily EBITDA or operating profit. We used to look at a function called economic profit. And economic profit is net profit minus the weighted average cost of capital. In other words, saying to yourself, if I took this money
and invested in a money market,
put it in a money market account and got 8% for it, and you're only giving me an 8% growth on profitability year on year, I might as well take the money out of the business and put it into a non-risk account, money market account, and I'll do fine, thank you very much. So what we used to do in a corporate environment was we had to deliver, as executives, we had to deliver growth, double-digit growth net of inflation. Now, in America, obviously, inflation has never been a massive thing up until possibly the last 2 to 3 years. But in environments where inflation is a key component of how what happens in business. If inflation's running at 5%, generally speaking, our responsibility was to make sure we're delivering 15% plus at profit growth level, not profit as a percentage of revenue, profit growth level. Because the investor will be turning around and saying, hang on, but if I took this money and put it into a money market account, I could do better there or commensurate with that with no risk.
So the concept is business owners their job is to turn their company into the hottest stock ever.
Yeah.
The returns are so much better than money market, so much better than alternative investment vehicles. Wow, what an interesting way to look at it.
We to your point, when we looked at executive level many years ago, we always compared ourselves to the number one FMCG business in the market globally. And we compared our stock price relative to theirs and said, why are we being undervalued by the market, the investment market, relevant to that? And what do we need to do in delivery of consistent performance to the business, as well as the story we tell the investors that values our business to the level that they were?
Yeah.
And so it comes back to me as what I've said early on today, is that there are two components that you'll always look to. The two words, consistency and discipline. The market does not, when you look at it from an investor perspective, the market does not value a business that performs against its target this year but doesn't perform next year, that performs the year thereafter but doesn't perform the next year. They'd rather you commit to 5% growth per annum
and hit it.
Consistently.
Yeah.
Because in their mindset, we can trust this team of people who are delivering this, than somebody who overpromises, underpromises and overdelivers. They don't like that at all. They don't like it.
And that's
you commit 10% to me and deliver that to me consistently, you're fine. Because even when we used to work at sort of double-digit net of inflation, we were looking at figures ahead of about 20%. And we set ourselves a target should be 20% growth at net profit level or economic profit level. You double a business every 4 years by doing that. You double a business every 4 years. And so what the market's often looking at is this a credible story? Historically? And is the story they're telling me commensurate with the future opportunity that I'm going to get when I buy?
Yeah, and I think there's a big lesson that people go through when they share their financials externally for the first time, right? Whether it's to an external third-party valuator, if someone's going to give a valuation to your company. I think the lesson is never share your stretch goals with a external party, right? If you have a big stretch goal, we're going to go from 20 to 100 million this year. Don't share that with an external party. Especially don't share that with a potential investor or, someone that you could fail right in front of, right? Keep the stretch goals internal. Motivate your team with them. Talk about how we're going to hit this big stretch goal plan. But the only thing you should ever send to someone external is something you'd bet your paycheck on. Come hell or high water, we're going to hit at least this, right? So that's all the time we have today. Was great to sit down with you, Pieter. Ton of business wisdom. I'm sure we could go on for hours. And I love how you've made some of these complex business concepts so simple in terms of, the way you've kind of distilled them down for people to understand them. So make sure in your own business you don't overcomplicate it. Just keep it simple, right? And make sure you're always learning from people like Pieter to be able to distill down what your next growth step's going to be and keep that growth path very simple right in front of your eyes. So I'll see you in the next episode. Stay great. And tell a friend if you're feeling up to it about the Bill Hauser podcast. See you next time.